Give you another example. Just made a couple more offers to a seller. He's selling off 6 properties right now. He knows he's going to get crushed in capital gains. So instead, I said, why don't we take 2 of those? You already got as much money as you needed up front. Why don't we take 2 of those and let's do owner financing, and now let's kick down the road or taking small incremental capital gains over a longer period of time. And then you and I can speak strategically of when you want this property cashed out. So then you know you're going to get hit with another tax burden. So those are just some strategies. So we have a wide range of people. And again, specifically in today's market, price is a big factor for sellers. And because buyers are unable to qualify, or the buyer pool is so much smaller than it used to be because of the interest rates. And then, of course, debt relief right now, because there's so many people that are either unable to make monthly payments or mortgage payments right now, and we can step in and help them right away.
Welcome to CREPN Radio for influential commercial real estate professionals who work with investors, buyers, and sellers of commercial real estate coast to coast. Whether you're an investor, broker, lender, property manager, attorney, or accountant, we're here to learn from the experts.
Welcome to Commercial Real Estate Pro Network's CREPN Radio. Thanks for joining us. My name is Darrin. This is the podcast focused on commercial real estate investment and risk management strategies. Weekly, we have conversations with commercial real estate investors and professionals who provide their experience and insight to help you grow your real estate portfolio. Today's program is sponsored by Building Insurance and Risk. When you invest in real estate, it pays to work with a real estate investor protection specialist. What happened here? Hold on a second. Sorry. My little script thing got twisted up here. Hold on, let's even push the pause on this record here. I gotta give you 1 second here. Okay. Welcome to Commercial Real Estate Pro Network's CREPN Radio. Thanks for joining us. My name is Darrin. This is a podcast focused on commercial real estate investment and risk management strategies. Weekly, we have conversations with commercial real estate investors and professionals who provide their experience and insight to help you grow your real estate portfolio. Today's interview is sponsored by Building Insurance and Risk. When you invest in real estate, it pays to work with a real estate investor protection specialist to protect yourself and your investment from catastrophic loss. The experts at Building Insurance and Risk focus on real estate investor protection. They provide you with multiple insurance coverage offers and a side-by-side coverage comparison. To learn more, go to buildinginsurancerisk.com. Today, my guest is Zachary Beach. Zachary is a returning guest and is an Amazon best-selling author of the New Rules for Real Estate Investing and the co-host of Smart Real Estate Coach podcast. He's a partner, the CEO, and a coach at Smart Real Estate Coach. And in September 2020, they re-released a revised edition of the Real Estate on Your Terms book, which Zachary co-authored. And in just a minute, we're going to speak with Zachary Beach about real estate on your terms, making real estate deals making real estate deals happen in 2024. But first, a quick reminder, if you like our show, CREPN Radio, there are a couple things you can do to help us out. You can like, share, and subscribe. And as always, we encourage you to leave a comment. We'd love to hear from our listeners. Also, if you want to see how handsome our guests are, be sure to check out our YouTube channel. You can find us on YouTube at Commercial Real Estate Pro Network. And while you're there, please subscribe. With that, I want to welcome my guest, Zachary Beach. Welcome back to CREPN Radio.
I appreciate you having me back. I think timing is perfect right now in 2024. I know you and I were speaking offline, and we were like, look, the audience may know about creative financing. They may know about buying and selling real estate on your terms, which I'm sure we'll cover just a slight bit again. But we were talking about like how we're doing and ramping up real estate investing in today's market, where most would say is not a good time to invest. So I'm excited to have a conversation here on the radio.
Well, man, I appreciate you coming back, and I look forward to getting into it. Just as a reminder for our or for our listeners, if you could take just a minute and share a little bit about your background.
Sure. Yeah, back in 2014, I was a bartender and personal trainer, and I was burning the candle at both ends. So I was spending late nights bartending, and then really early mornings personal training. So what I was looking for was I was looking for a way out. I remember it was about 4:30 in the morning after a bartending shift. My wife also was a bartender at the time, and we looked at each other and we just said there has to be a better way. So what we ended up doing is we approached her father and my father-in-law, who was revamping his real estate business. He got crushed in 2008 and was getting back into investing in real estate through the methods in which we've perfected now here today, known as creative financing. And I ended up joining the family business back then and started from the ground up, from making cold calls to doing everything possible in order to, change my life at that point in time. And then from there, it took me about 6 months to get my first deal complete. And once I did that, I was hooked, and I hit the ground running from there and haven't looked back. And it's almost been it's going to be 10 years this year in my real estate career. So it almost feels like a lifetime ago now.
That's awesome. Well, congrats on your success and the 10-year anniversary. That's exciting. So, Zach, let's talk a little bit about the current market, the state of the market. And I think one of the things that I want to get your opinion on and get your viewpoint of is I think a lot of the prognosticators and people that are talking about the market, they continue to project as though the market is going to do what it did last time. And I'm curious what your sense of, and I say the last time meaning the last downturn,
Sure.
In the '08 crash. From your perspective, how do you see this market compared to what you recognize the '08 market cycle to have been?
Sure. And I love that big word. I didn't even know what that was. Agnosticator. That was good.
Oh, prognosticaker. Yeah.
Prognosticator.
Yeah.
Oh, that's
Yeah.
definitely a $5
$2 word
That
there.
was
So
good. Yeah, it was good. Well, full transparency, as you guys are watching YouTube, I wasn't a real estate investor in 2008. Well, but luckily enough, my partner was. He actually got caught with it was 30. It could have been more. From what I remember, 30 condo conversions when the 2008 crashed, and it went down to a third in value. So as you can imagine, when he was looking at new strategies to get involved in real estate investing, he certainly had that in mind. And that's why we buy with creative financing, which just simply means without putting large down payments, without going to banks, and without personally guaranteeing the debt. And most importantly, the not personally guaranteeing the debt, because that's what really affected him in 2008. So with that being said, the 2008 crash, that was a completely different market in my opinion. Although we have really protected our downside when it comes to that, because the 2008 crash came because of bad written loans. Now, when we look at, say, the COVID market or the market that we are sitting in here today, we're talking more about drastically increased purchase prices. But it doesn't mean that was placed on bad debt. It was actually on very low interest rates. And now if you look at today, interest rates have skyrocketed, which their intention was to slow down the market. And in some circumstances, that certainly happened. And because when I say market, right, most people will say the market. And the reality is I'm sitting here in Massachusetts, and I can name at least 5 markets in Massachusetts, and it's probably one of the smallest states in the United States. So when we look at those individual markets, they're all affected slightly different. So it's going to be really important in today's market to be looking at individual markets and looking at where the advantage is. And that's certainly what we're doing here, because I can tell you that I'm investing a lot in, say, like the state of Connecticut, because in certain parts of Connecticut, but Eastern Connecticut, to give you a target market. And the reason why I'm doing that is because in this very section, the purchase prices have not drastically increased, and have not priced out a lot of investors in that standpoint. So you definitely want to be picky in terms of market right now, but also in every single market that we've been in, there's always going to be the same challenges that some individuals face, right? You have death, divorce, job relocation, downsize, upsize. So no matter what, you're always going to have problems that sellers have. And with those problems, they're going to need alternative solutions when it comes to this type of market. So shifting back to like looking at it as an overall broad stroke, right now, drastic increases in interest rates have made it so that there's a big portion of sellers that can't sell right now for at least their price. So we have a giant pool of unrealistic expectations of sellers. So the market probably is sitting on the market longer. And then also at the same time, the buyer pool is being affected because it's not that many people that can actually qualify for bank loans at a 6.5% to 7% interest rate. And that's with good credit. So in our world, in the creative financing space, like this market is perfect for us because you have a growing seller pool and a growing buyer pool at the exact same time. So that's why when we were talking offline, Darrin, I was saying like we've actually strategically put more resources into buying more real estate right now because we believe this is a perfect market for especially our strategies to go after and to buy more real estate because there's so many different factors that are involved, right? Because when a seller that's selling today and they purchased within the last 3 to 4 years, they bought the interest rate, which means they probably put little money down. And if they need to sell, they probably don't have a ton of equity, which is a huge market for us as creative financing investors because they don't have a ton of equity, which means they're probably going to need to either come out of pocket or make very little money. And there's still tons of people that will move. So with that being said, we now have a huge opportunity to actually step in and use these creative financing strategies to help those sellers move on. But because of that low interest rate, it's advantageous for us because we can actually profit because we now can sell to, and we primarily sell our single family homes to rent to own buyers or people that need time to qualify for loans. We can create a good margin there because the average tenant buyer, if they were to go purchase a property, is going to need a 7% interest rate, which means that there's a great delta there for us to make. So there's a lot of different factors. That's just one of the circumstance here, but there's lots of different factors on why today is actually a better market compared to 2008 for us. And really because of the 2008 crash, we're affected and strategically looked for markets like this, and we're prepared for markets like this. And that's why we're absolutely taking advantage of the current circumstances.
Yeah, I want to just make sure the listeners understand because I think the strategies you use I'm familiar with, but maybe we should back up just 1 second and just talk about the different strategies because then I think it'll make more sense what the opportunity is. So walk us through take your pick. Somebody basically they need to sell.
Yeah.
Like you said, either death, divorce, or just downsize or whatever. But they need to sell. So you have the qualified seller is somebody that needs to sell. Now, walk us through kind of the offering and how you guys, or what it is that you look for and how you can qualify, and also I guess you mentioned kind of the challenge they face trying to sell in the open market.
Yeah. So let's continue to dive through. And if you've heard of creative financing, I promise you, it took me like years in order to, and I was actively doing it until to grasp every single aspect of it. So it's always good repetition in general. So when we look at the spectrum of sellers that we buy from, and we'll just stick on the seller side here for a moment because the acquisition can be all creative financing and through these strategies. And then the disposition could just depend upon your business model. So you can acquire real estate this way that I'm going to talk about here in a second. You can sell on rent to own and tap into our federally trademarked 3 payday system, or you can do rentals. You can do Airbnb, short-term rentals, mid-term rentals, long-term rentals. You can flip them, you name it. It's completely up to you. So let's put the disposition aside and let's talk about just acquisition. So we buy probably basically three different ways. We buy on lease options, which lease options are basically just the ability to control an asset. I mean, you take over any and all responsibilities of that property. You lock in a specific purchase price with a seller, and then you go ahead and now you have the ability to go sell it or continue to maintain and keep it. So that's one strategy. That in that circumstance, the title does not transfer. It's just controlling the asset. The other ownership strategies are buying a property subject to the existing loan. So I recently just purchased a property. Let me give you this example. I recently just purchased a property from a seller. The seller was interested in, the seller's about to go through a divorce. Not a lot of equity in the deal. They've actually just did another loan modification. So there's not much equity in this deal for them. So they're just looking for moving money in order for the couple to just split. And the property needs a little bit of work. Now, every single deal that we buy is typically move-in ready, and this being the same. Some being like brand new and some being, lived in, and this one happened to be lived in. This particular seller, again, wants to relocate and just wants to eventually get out of the property. So I went ahead and purchased this property subject to the existing loan, which means that we keep that mortgage in place. Title transfers to our company, and then we just maintain that mortgage until we eventually cash out that particular seller. Now, this property, I'm looking for margins in the property. So I'm going to go sell it on rent to own in this circumstance because the property is probably only worth maybe a little bit more than what I bought it for. So I want to increase the equity in it by selling it to somebody that can't qualify today, but can qualify in a couple of years, which means now I can sell it at a premium. And then in the meantime, cash flow it. So that's one of the circumstances there. And then the last way in which we buy is owner financing. So this is a drastically different person than the person I just spoke about. This tends to be the tire landlord or the out-of-state owner or somebody that owns a couple different properties, or more importantly, somebody that does not want to have to handle or have to pay realtor commissions, closing costs, but they want to maximize their profit. I'm currently working on a deal. I have an offer out to a seller. He used to be a landlord. This is like one of 50 properties of his. And what he wants is he wants his price. And unfortunately, the traditional market is not giving him his price for traditional market reasons. This particular property has a steep driveway, and it's next to a lake, but has a really steep driveway. And he's even tried to give seller credit or buyer credits to fix the driveway. But a lot of people can't see past some of those challenges. So instead, I told him, look, I'll go ahead and purchase your property on owner financing, which means that you'll be my bank. We'll agree upon a price. We'll agree upon a monthly payment, and then we'll agree upon a time frame, which I'll pay off in a balloon. We'll close on it, and then you just be the bank, and I just make monthly payments to you. Very advantageous for the landlord that doesn't want to deal with tenants, toilets, and trash. Very advantageous when it comes to tax benefits, when it comes to capital gains, because he's able to spread it out over many years. Give you another example. Just made a couple more offers to a seller. He's selling off 6 properties right now. He knows he's going to get crushed in capital gains. So instead, I said, why don't we take 2 of those? You already got as much money as you needed up front. Why don't we take 2 of those and let's do owner financing, and now let's kick down the road or taking small incremental capital gains over a longer period of time. And then you and I can speak strategically of when you want this property cashed out. So then you're going to get hit with another tax burden. So those are just some strategies. So we have a wide range of people. And again, specifically in today's market, price is a big factor for sellers. And because buyers are unable to qualify, or the buyer pool is so much smaller than it used to be because of the interest rates. And then, of course, debt relief right now, because there's so many people that are either unable to make monthly payments or mortgage payments right now. And we can step in and help them right away.
Yeah, I love all of those examples and the different models that you guys use. It's funny, you mentioned it, and as I was sitting there listening to you, just the asset of the low interest loan that the seller has in place. So like you said, even when they don't have any equity, if that loan's in place and there's a lot of runway on there, and you've got sub 4 or something, and the market rate 7. What's a typical rate for a lease to own or a rent own buyer?
Yeah, great question. And I believe the stats are, and don't quote me specifically, but I believe it's 4 out of 5 houses in the United States are at 5% interest rate or less. So massive opportunity. There's an entire new segment in real estate because of these interest rates. And I say that because like the last couple deals that we purchased were directly off of Facebook groups, because there's now a large group of people who will go out there and get these properties under agreement for the interest rate, and then basically wholesale that deal to somebody like myself that wants to keep it, own it, and actually be the investor involved. And we're looking at the interest rate. That's a big component, and how little I can get into that specific real estate deal. So you're actually seeing a whole new ecosystem or another space in the ecosystem of real estate investing now, specifically around putting properties under agreement for the interest rate and then marketing them, which is extremely interesting, right? Because that is the asset right now, is the interest rate. And that's the whole subject to the existing loan model. When it comes to selling on rent to own, really the way it's structured, and we call it our 3 payday system, the way it's structured is there's really 3 components to every single one of these deals. So when I look at it as an investor, I'm not necessarily just looking at the monthly payment, which the monthly payment is just rent. It's not an interest rate. It's just rent. So where that rent ends up being is somewhere around we'd like to be a little bit more than what their mortgage rate would be. But in today's world, that's probably unrealistic when it comes to the market. But what is really advantageous for us in this rent-to-own space is we can actually rent to own deals for a lower monthly payment than they would to get their mortgage, which has its positives and negatives. Positive is we can typically fill properties a lot more quickly because they're already sticker shocked from the mortgage lenders. But negative, I would say, or caution to be aware of, is that buyer eventually, assuming rates stay exactly the same, needs to understand that their monthly payment is going to increase when they go qualify for this loan. So that's more of an education process. And then the other components when it comes to our deals, and this is why even people that have private money are starting to get involved in these rent-to-own creative deals. And that's because you're getting a large lump sum up front. It's a non-refundable deposit, anywhere from 3 to 10% of an elevated purchase price. Then you get your monthly cash flow, and then you're building an equity in the deal over time as well, which is your payday 3, which is eventually when this deal cashes out, you have built-in equity, and now you're receiving another lump sum. So it can be super advantageous when it comes to today's current market for all those factors involved and many more.
Yeah. In the as far as the space goes, I know a lot of these opportunities are single family homes. Are you finding any similar kind of a marketplace with any of the commercial properties?
Absolutely. What you're starting to see now is actually the larger multis are now being open to seller financing or are strategically selling on seller financing. I know some people with very large portfolios right now that are strategically selling some of their portfolio on seller financing. It's long-term interest rates, and they're getting a bunch of money over a period of time, and they don't have to manage the asset. I was speaking with a realtor the other day, and there's a seller. So I happen to be in Worcester, Massachusetts, or right outside it, and it's an upcoming market. And you used to be able to get a 3-family home, for like, 3s or 4s, and now they're selling for like 6s and 7s, and sometimes they're trying to get as high as 8 based on rent, which is interesting, right? Because this is where creative financing gets involved, because it is very hard to cash flow those types of properties at the interest rates of today, unless you're putting very large down payments. So you're starting to see commercial real estate being greatly affected by this, which is making it extremely popular to do seller financing on this, because like this particular seller, he's trying to sell off, I think it ends up being like 25 units. It's compare, it's a mix of like 6 units and 3 units all together. And he's willing to do seller financing now with like say a 20% down, as long as he's able to get closer to his purchase price. Now, you and I both know that it's going to probably take some money to increase the rents on them, redo the units. But as long as he's willing to do long-term debt on it, then, you can take your time versus trying to do quick turnover, because it's not like you've raised lots and lots of money in order to get your investors out of this in a short period of time. But instead, you can use investor down payment money and then chip away, as long as it's cash flowing and can sustain that debt. So we're starting to see tons of that. I mean, we bought our commercial building, which we just sold, bought it for like $515. I want to say 5% down at a 5.21% interest rate. This was a couple years back, and then we just went and sold it last year for 1.2 to a group of people who owned multiple nail salons, and they're turning this commercial building into apartments. So that was, a great opportunity for them and a cool opportunity for us. So we were able to make significant amount of money on that property, specifically because that interest rate was very low. And that particular seller, if you're wondering why he would sell for that, he was interested in creating cash flow for his trust, and he was actually ended up getting sick, and he didn't want to have his family maintain that property. So we went in and did some work and fixed it up and placed our own companies in there. That was a full commercial building. So yeah, lots of opportunity in the commercial space. I would say specifically lots of opportunity in the small multifamily space, because those are still ran and operated by, mom and pops. And eventually they're going to try to get out of it. And if they can't get their price right now, or they get tired of being a landlord, they're not going to go hire a property manager. Instead, they're going to try to figure out a way to exit out of these.
Yeah. No, that's I appreciate you going into that. Let me ask you this. So somebody that's listening to this and has maybe thought that they're going to wait until the market corrects, or that the interest rates drop, or something that it'll be too late, kind of thing to really take advantage of. What would you encourage them to do, as far as, I guess, as a step one, and what to look for as far as the opportunities?
Yeah, my personal opinion, I think opportunity is all perspective, right? I was having a conversation with some of my teammates, and there's people that will come speak to us and they'll say, there's no opportunities anywhere. And then I'll speak to a person in the next room and they'll be doing 10 deals a month. It's all perspective when it comes to that. And what we talked about here today is specifically tailored to this type of market. So there's no reason, actually, the longer you would wait to get involved, then the less likely you're going to get access to low interest rates, right? Because as the years compile on, now this next new wave of single family properties, multifamilies, all their interest rates are significantly higher than the last wave, all the way up until COVID, right? Because even the most loans that I saw over the past 10 years were like 5% or less. So those are all loans for the past 30 years. And now the longer you wait, the higher the interest rate's going to be. Now, because in our space, we're buying somebody else's debt, or we're buying someone else's property and maintaining somebody else's debt, I should say. So for us, I mean, the opportunity is now, because there's, like I said, 4/5 of the United States are 5% or less. Like, there couldn't be a better opportunity to get involved in creative financing. And also the stress on the market. And I want to say this, like the stress on the seller's like the psychological factors of where we're currently at, with all the different factors. Like if you add in like the election year, you add in high interest rates, you add in the instability of the economy. All of these are fear factors that are going to drive a seller's decision to sell sooner rather than later. Now, you as the intelligent investor should know that that's actually advantageous for you, because now you don't have to create strong motivation. They already have it. Now we just have to provide them with solutions that are not just, one trick pony, which is just not go put it on the open market, see what you can get. Instead, we can now provide multiple solutions. I could say, look, this could be advantageous for you and your family for a long period of time. I can tell you that most properties that I buy, the seller's going to net anywhere from 5 to 15% more than they would on the traditional market. Now, I can put those into factors based on the current realtor rates. You can put that on closing costs. You can put that on the fact that most sellers are only going to get roughly 97% of their asking price in most markets. You can put that on the fact that some of the ways in which we structure, sellers are going to get either a premium on their property, or they're going to get a monthly payment that they would have never got, or an interest rate that they would have never got. And all of those factors come into actually increasing the seller's net worth, or the seller's ability to make money off this property just as much as it does us. So huge opportunities right now across the board. So all of those factors, scream, get involved in real estate investing now. You don't want to get involved in real estate investing when it's calm, cool, and collected. Nobody has any urgency to do anything. Right now, everybody has every reason to be urgent, or at least the media has manufactured every way for them to be urgent. So now you can take advantage of that. And I mean, take advantage of that in a positive way, provide solutions to people. And that's how you're going to see profits.
Yeah. No, amen to that. That sense of urgency, I think, is something that's really easy to get kind of, weighed down in the noise, and not recognize the opportunity. And then when you think the opportunity, or when you hear everybody talking about how they're making it in real estate, the opportunity is essentially, past, or at least the best opportunities have since passed. But that's good.
Darrin, what most people don't realize is everybody that has success in real estate, there was like 10 years, 5 years prior that they were grinding it out and trying to figure out how to make money in real estate. Right. And then, because I'm just as naive, all of us are just as naive, right? Before we get started in this business, we think that things are going to happen a lot more quickly than they typically will. And we underestimate the amount of effort that's going to be required in order to go out there and reach our goals. When it comes to HGTV, does a really good job of making it seem really easy to make money in real estate, right? So, so most of us, especially previous to being involved in real estate investing, there's a facade out there. So the amount of work that it takes eventually to become successful in real estate is everything that's happening before you find that success, or before you monetarily start making the money that you're hoping to make.
Yeah, no, that's a great point. I think, it is one of those things where we get caught up in the shiny object or whatever, where you find out that everybody that's having success, not realizing what they put into it, like you said. And then also, I think the people that I find that are like really vested in and or committed to real estate understand more of the time. It's not like a stock pick where you got a hot tip, you bought low and you got out on top. And the reverse of that, I can tell is, a number of people I know that bought a stock and didn't have the patience and got out, and then it took off, or they sold low and it went, bought high, sold low, or whatever. I think real estate, if you're committed to it, and especially you have a long view of the game, you can't help but win, because the market trends up. You've got an asset that's appreciating. You've got, if you've got your income, if you're doing a rent situation, you're getting a spread between the income and the expense, whether it be the mortgage or whatever you've got in place. And then, the thing we haven't talked about is, your tax benefits. And let me ask you real quick, just to be clear on the different models you have, because on a straightforward, you own it and operate it, you get the depreciation. In these lease to own models, I know you're getting the income side of the spread between the rent versus, or the rent, or whatever the lease payment, as opposed to the mortgage cost and that. And so I'm assuming, are you still receiving the benefit of the mortgage interest write-off as well as the depreciation in that model?
Yeah, let's walk through it. So if I'm buying it on a lease purchase, then no, it's active income because the seller is still on title. Now you're clouding title with an option. That way you don't a notice of option on title, so that way the seller can't go sell it to their uncle. But other than that, you have an agreement where you're controlling the asset. That's why most will then graduate, right? You can get into creative financing with some lease options, good opportunity, especially if a seller won't give up title to still make money off of it. But you eventually graduate to buying property subject to the existing loan, which means that you now have ownership. So you're going to get depreciation off of it, and or buying it on seller financing. You'll have title, so you also get depreciation off of it.
Got it. Got it. No, I think the opportunity for creative financing, has never been brighter right now. I know the first deal I did that got me into it, it just really opened my eyes to just how, um, the marketplace is where a buyer and a seller meet.
Mm.
And if all you've ever experienced is the sign in the front yard and worked through a realtor and two realtors, negotiating, and you're trying to buy something that everybody wants, and you're paying more than the asking price. Um, that's not the creative side of things. That's the normal market. But if you get into a situation where you have and this is my experience, I had a seller that had a property he wanted to get out of because he wanted to get into something different, and he gave me a price. And I remember I went home and I tried and I tried and tried to make the numbers work. And the one thing I remembered him saying was he needed $10,000 so he could go buy this other property. And I recognized I had a line of credit that I could get $10,000 from. And so I backed into the numbers and I said, well, if I gave him 10,000 and here's the rent, how much could I afford, and what interest rate could I afford to pay? And so I came up with a number well below what he had offered. And I offered him up, and he says, okay. And I was like, well, what? Wait. It's like, I thought, oh, I left some money on the table there, kind of thing. But it really opened my eyes to just how creative you have permission to be as creative as you want in this.
100%.
And I implore any of the listeners that are thinking about it to, throw out the thoughts of the conventional marketplace when you're getting into this, because it really is as creative as you are willing to get, is the opportunity. So that's great. Hey, Zach, if we could, I'd like to shift gears here for a second.
Sure.
As I've told you and the listeners know, by day I'm an insurance broker. And as such, I work with my clients to assess risk and determine what to do with the risk. And there's three strategies we typically consider. We first look to see if there's a way we can avoid the risk. When that doesn't work, we look to see if there's a way we can minimize the risk. And if we cannot avoid nor minimize the risk, we look to see if we can transfer the risk.
Mm.
And as such, I like to ask my guests if they can look at their own situation, their clients, investors, the interest rates, market, the Fed, whatever you consider to be the biggest risk. And again, for clarification, while I am an insurance broker, I'm not necessarily looking for an insurance-related answer.
Sure.
And so if you're willing, I'd like to ask you, Zachary Beach, what is the biggest risk?
Yeah, I'm glad you brought that. Like, it's interesting the way you walk through all of that, because that's essentially what we're trying to do, is minimize risk as much as possible. Warren Buffett always said that they all make all the best investors out there, not specifically real estate, look to minimize the downside and maximize the upside. And I think that's exactly what we've done here with creative financing. Because, right, when we buy a piece of real estate, we're not personally guaranteeing the debt. So we are not taking on the risk of the debt. It's actually on the seller. So we're actually pushing it back to the seller. And then what we're then doing is we're actually not taking on the full risk of the property either, because when we go sell on rent to own, we're actually pushing the risk now to the tenant buyer for handling any and all responsibilities of the property, because it's tied to his option. So it's very interesting that you hear that. So our biggest risk when it comes to these two deals, one, if it was a subject to deal, the biggest risk always involves is the due on sales clause. So then how do you manage that due on sales clause risk? Well, we buy the property in a trust. And then because the Garden St. Germain Act of 1982 allows you to transfer ownership of a property for estate or tax planning purposes. So we use that to try to manage the risk. And then there's lots of insurance companies nowadays that actually have a due on sales clause insurance now as well. So that's where we certainly minimize that. So then if we look on the buyer side, what's our biggest risk? Now, our biggest risk is if our buyer defaults on the option or the rent to own deal, which means that we got to go to traditional tenant law, which means now we got to deal with an eviction. So when we look at that, those are going to be our biggest risks involved, and we do our best to manage that tenant buyer risk by getting as big of a non-refundable deposit as possible, because it's less likely they're going to default if they have more money involved in the deal.
No, that's more skin in the game. You're in. That's a good way to minimize your risk. I like it. Zach, where can the listeners go if they'd like to learn more or connect with you?
Yeah, I'll give you guys a couple different places. First and foremost, if you feel as though buying and selling real estate creatively, I'm biased, but I believe it's the best way to structure any deal possible, especially being option number one. If you believe that that's a route that you want to go, I want to give you our Amazon bestselling book, which Darrin mentioned at the beginning. It's been completely redone since 2020. So it's as relevant as possible when it comes to this market. And you can get that book at wickedsmartbooks.com/CREPN. That's wickedsmartbooks.com/CREPN. That's real estate on your terms. We'll go through all the different ways in which we buy and in depth. And then if you want to contact us or find us on social, you can find everything at Smart Real Estate Coach. And then if you want to follow me personally, it's at Zachary Beach Official.
Awesome. Well, Zachary Beach, I can't say thanks enough for taking the time to talk today. As always, it's good to hear from you. And I always learn a lot in this. I love revisiting the topic and understanding it. So I appreciate that. And look forward to doing it again soon.
Thanks, Darrin.
All right. For our listeners, if you like this episode, don't forget to like, share, and subscribe. Remember, the more you know, the more you grow. That's all we've got this week. Until next time, thanks for listening to Commercial Real Estate Pro Network's CREPN Radio.
You're listening to CREPN Radio for influential commercial real estate professionals. For more information on this or any of our guests, like us on Facebook, CREPN Radio.